Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation.
All right. Good morning. This is James Bogart, CEO and President of Bogart Wealth. Thank you for taking the time to listen to the Bogart Effect. With me today is Nell Cordick, one of our lead financial advisors at Bogart Wealth. And we're going to talk about 2024 year-end planning.
Absolutely.
And to start, first podcast in our studio here.
It's fabulous. You did a great job.
This is, we've been talking about it for a little while, so this is pretty cool. So, all right, year-end planning. I feel like this is a conversation that we're having day in and day out with clients, their kids, et cetera. Let's kind of break it down a little bit and talk a little bit about how we can have impactful decisions being made before the end of the calendar year. And then we'll talk about, kind of advanced planning into next year.
Absolutely. James, thanks for having me today. I would say first and the most important thing is that everyone should do a full review of their financial plan before year end. Things have changed from a year ago. Your spending habits have changed from a year ago. And you need to see, are you on track for your goals? What new goals have you added? And what adjustments need to be made for the future?
Well, and let's not discount the markets have had a pretty good year here, right?
Absolutely.
And I'm noticing in client situations that because it was a good year, I think a lot of people are spending more this year,
Correct.
right? But is that adjusting the base?
That's right.
And I think it's important, to your point, you got to have a plan. And to me, the plan's the baseline for all the decisions that we're making. And we think about value-oriented planning, it's really the integration of the financial plan, the investments, and then a lot of these tax and year-end conversations.
Absolutely.
It's not one decision. It's the accumulated benefit of those decisions over and over and over again that really create the most value.
Absolutely. Because if you can make decisions that are tax advantaged for you, and that is a cumulative number over a number of years, it makes your position become so much better in the future.
Bingo. So let's start with talking about employees and people who are still actively employed, because there is a cadence of decisions that they really need to be following. And then we'll transition and talk about, let's just say, everybody else.
Perfect. That's great. So for employees, there are quite a number of things that an employee should do. I would say first and foremost, they need to really look at where they are in their contributions to their company retirement plan or an independent IRA. It is important to maximize those contributions. And secondly, if an employee is over 50, to look at where they are in the catch-up contribution. That's kind of a freebie that a lot of people do not take advantage of in order to affect their year-end numbers. So that's the first place I would start.
So talk to me about what does that look like, right? Do you go to the 401k plan and see what you've done year to date, and then
you do. And you look to see all 401k plans will allow you to make adjustments in terms of the percentage that you are contributing. So if you see that you're not going to maximize by year end, you can adjust your contribution, provided that you've got the extra cash flow to do it. And then secondly, with your catch-up contribution, usually there is a way that you actually adjust that online through your online portal with your 401k provider with your human resource provider. That adjust your catch-up contribution.
Well, and I know in some of them, they allow for special contributions.
Correct.
Right? So you can kind of see what else is left, and then you can write a bigger check.
Absolutely. Now, the other thing, there are some plans out there that do allow you also to put in after-tax contributions. And that's another key thing that you can do as a lump sum contribution, to put in an after-tax amount. Now, why would you do that?
That was just what I was going to ask you.
You're going to ask me. The reason is there are some plans out there that you can do a mega backdoor Roth conversion. And basically what that is that you're taking after-tax dollars, converting it into a Roth IRA today so that it will grow tax-free for the rest of the time you're employed, which can be a huge tax benefit.
So the specific nuance of that plan is the 401k plan has to allow for tax-paid distributions.
That's exactly
right. Which is after-tax contributions that are allowing you to pull it out. And I think this is kind of a bigger overarching conversation because, wealth creation and wealth accumulation, a lot of it is the positioning of the assets, getting them in the right place. And what we're talking about here is the let's just say optimized portfolio structure, specifically the type of account and how it's accumulating. Humor me for a second. We're going to talk about the 3 different account types, but you've got non-qualified accounts. This is brokerage accounts. With those, you have qualified gains rates on dividend. You pay ordinary income rates on income. You pay capital gains rates when you sell something, right?
That's right.
But there's no nuances of age. There's no required minimum distributions.
That's right.
It's just tax burden along the way.
That's right.
And then you have qualified accounts. This would be a 401k, it'd be an IRA. All of that is before tax money. So you put the money in, it grows tax deferred.
But you get a tax deductibility when you put it in.
Correct. So for example, if somebody makes $200,000 and they put, let's just say $20,000 into their 401k plan, their $200 becomes $180 from a taxable perspective.
Absolutely.
So you're saving at the highest marginal bracket. But it is tax deferred. So when you go to take the money out, typically in retirement, you pay ordinary income as it comes out. Now, I would say that ultimately the biggest negative is for somebody who has large pre-tax accounts, because when they attain the age of required minimum distributions, there's a percentage of that account that has to come out. By the way, this only impacts about 4% of Americans, right? So it's not like a huge problem, but for any corporate employee that has a big pre-tax environment, this is a very active conversation of where we're saving and how the wealth is accumulating, because it can have a meaningful impact as you compound that over a 30-plus year career.
Absolutely.
So that's the qualified world.
And one thing that we have recently been even looking at is clients that have very high discretionary income that do have these large qualified plans that will be huge RMDs at some point in the future. Through our financial planning analysis, we're actually showing that they may want to use a Roth 401k, pay the taxes now, and continue to get that tax-free growth through the rest of their life.
You're stealing my thunder.
So it's something that we are looking at.
Well, and so let's talk real quick about Roths. Roths are money you put in on an after-tax basis. They grow completely tax-free. So all of what you've put in plus the growth will come out tax-free as long as you're over the age of 59 and a half and it's been in existence for more than 5 years.
That is correct.
So, and no required minimum distribution. So to your point, there is a scenario where even while you're in the accumulation phase and you might be in a higher level of income because of the amount of discretionary income you have, that it makes sense to look at Roth. By the way, the way that they're structuring 401k match contributions for individuals is going to ultimately mandate high income individuals to only be doing Roth.
That is exactly right.
So there is a part of this where changes are coming, right? We know that's going to happen. But it also isn't necessarily as detrimental as it might appear to be because of the longer term perspective associated with how that wealth is growing and accumulating.
That is exactly right. Now, while we're talking about different IRA strategies, one other thing to think about, and this can be very specific because you do have to talk with your advisor to fully understand if this would be a good program for you, but doing a backdoor Roth contribution as well. And this is where your income limits you from doing a straight Roth contribution. However, if you do not have any outside IRAs, if you only have your 401k money, it can be something very easy to do, very easy to set up. And it just adds another element for your long-term effect. This is very, very effective, especially for younger employees.
Well, and I want to pull on that thread a little bit, simply because I also think it's a great way if you have a non-working spouse.
Correct.
Now, I want to summarize because it can get the nomenclature can get a little confusing. We've talked about mega backdoor. We've talked about backdoor. So mega backdoor is specifically using the 401k as the mechanism to put the after-tax money in that we then convert it out to a Roth.
That's correct.
A backdoor is where we use an IRA and then put it in on an after-tax basis to the IRA and immediately convert it.
That's right. And it does not go through your 401k.
Correct. But there is a pretty distinctive difference between the two. The 401k can do a significantly higher amount of after-tax contributions into it. And there can be a balance in the 401k and it would still allow you to get the large percentage of that money out completely
That's exactly right.
tax-free and then growing tax-free. But with a backdoor, you can't have an IRA and it have the same level of impact. And the reason for that is because if you have a pre-tax balance in an IRA and then put an after-tax contribution, you only get a ratio of whatever that balance is as to what converts over tax-free. And so in some instances, it makes sense to look at if you might have a year that's a relatively lower year or you're younger, if you've accumulated some money in an IRA. I did this for my wife when we got married. She had a 401k that we moved to an IRA, and it just made sense because she's so young, or was at the time. She still is young, but get myself in trouble. But she was so young at the time, it made sense to go ahead and convert that IRA over to a Roth.
Absolutely.
So that now we could do this backdoor strategy every single year.
That's exactly right.
The one thing that I would emphasize with both of these, because I have a lot of clients that ask about this, in order to do them, you have to be working. You have to have earned income. Right.
That is exactly right.
And so it naturally precludes any of the, let's just say, retired category of individual. Yeah, they might have some discretionary cash flow, but if you don't have earned income, you can't do this.
That's right. Absolutely.
That said, you mentioned it earlier, and we'll talk a little bit about gifting at the end. But if you have children that are working and we're starting to talk about transitioning wealth, and again, it's another year-end planning scenario that we're going to be talking about, but the Roths, hands down, are the best place.
Absolutely.
Hands down. And so if you have a child that's making enough to be able to do a Roth contribution, that's a great strategy for mom and dad or grandpa and grandma to do a gift right into that. If they are over these income thresholds, which is a great problem to be in, but then they might have to do the backdoor strategy that we're talking about here.
Absolutely. No, that's for sure. And while we're on employees, before we switch over to non-employees, a couple of other things that you want to look at your employee benefit package, because there are really three key things that you want to be aware of before year end. One is if you are in a high deductible medical plan, you would be eligible to have participated in a health savings account. And if you did sign up for the health savings account, have you maximized the contribution? This is almost better than a Roth because it can be for any future spend as long as it's health related, but you don't have the requirement of waiting to 59 and a half. But if you do wait until 59 and a half, it is a great tool for using it for medical expenses in retirement.
And is that a calendar year contribution?
It is a calendar year contribution. However, a health savings account does not have to be spent in the calendar year. It can be spent in future years. Now, there is also, for all other employees that are not in a high deductible plan, there is a flexible spending account. The difference there is you do have to spend it within the time each year. And so that's another thing is if you do have a flexible spending account, have you identified where you're going to spend the money? If you don't spend it, it's forfeited. So you never want your own money to be forfeited. So that's very, very important. And then the third thing is to look at your health plan and have you already met your deductible for the year? If you have, are there any other procedures that you may want to pop in before year end? Because that's almost like you're getting a free procedure if you don't have to repay the deductible again.
Touche. I feel like I've got young kids, so it's like we're hitting that every year. It doesn't matter.
You're going to pay it regardless.
It's just cost of doing business.
Well, I do have one client, an older client, but he is still working, and he did a knee replacement at the beginning of the year. And the doctor said, well, hey, if you need to do a hip one, if you want to go ahead and do the hip by the end of the year, it's free. So
touche.
Makes sense.
Yeah, touche. All right. So we've talked a lot about employees at this point. Let's transition and talk about everyone else.
Correct.
And so it probably the largest category is going to be retirees.
Exactly.
But year-end planning is year-end planning.
Absolutely.
And I think really when what comes to mind for me in terms of year-end planning is very heavy tax, estate planning, and gifting.
Absolutely.
Anything I'm missing?
I think you covered it. So let's start with tax.
Please.
Because that is the most current event. So first you need to do a tax projection. Where are you looking to end at the end of the year? And then that determines what strategies you may want to immediately take. So number one, do you need to pay extra estimated taxes? Do you need to do extra withholding? Or do you need to employ strategies that could reduce the income? So depending on your age, there's several strategies that you could do. First and foremost, and mostly it's around charitable donations. If you're under 70 and a half, then using charitable donations as a deduction is your most optimal way.
And you can do, if you're going to do stock gifts,
Yes.
up to 30%. If you're going to
Correct.
do cash, it's up to 60% of adjusted 60 or
That was
50.
50.
Admittedly,
We'll check that to make sure.
No, I think you're right. Admittedly, I don't have a whole lot of clients that are doing that much. But it's up to 50%. I think you're right. We had a couple years ago that it went up to 60. But point is that you can do more if you're doing cash.
That's right.
But if you have highly appreciated stock, 30%.
That's
which is
correct.
the bulk of what we end up doing.
That is. But if you do more than you're allowed, it does carry over to
Correct.
future years. So especially with highly appreciated stock, if you have a stock that has really ballooned in its value and you want to go ahead and take advantage of that stock price this year, well, even if it's more than you need, you know that you can use it as a planning tool for next year and possibly be able to adjust your income for next year as well.
And so I'd probably put a caveat here. Anyone who's doing any charitable giving, if you have highly appreciated stock, you should do that first before spending cash.
I agree.
And the reason is because charities don't pay tax. So
That's right.
let's just say you have a stock you bought for $10 and it's now $100. Well, that $90 of gain
Absolutely.
would go to the charity completely tax free. And oh, by the way, if you're going to give them $100, we'll go back and buy that same share at a $100 cost basis, right? So that way you're not having to pay the unrealized gains off of those. And at some point, fast forward to retirement or when you need the money,
That's exactly right.
You're going to have to pay that tax. So the reality of it is that I really love anyone who has highly appreciated positions. They should be giving away stock.
Absolutely.
Now, that said, you made the comment a moment ago, it might be more that you need or you like the stock price where it is right now. Donor advised funds. They're phenomenal.
They are wonderful.
And there's such a low cost way of doing charitable giving, or at least creating a charitable account.
Absolutely.
Where we can take advantage of whatever the stock price is right now and you love that price.
That's right.
Move those funds over into the donor advised funds. The best part about it is you get a deduction for the amount that goes in that year.
That's right.
But you're not obligated to disperse any of that money.
Exactly.
Right. So it creates an account where you can put in a larger than you would normally do amount. But then, for example, for the next 3, 5, 10 years, you can incrementally distribute those funds.
That's
you know,
right.
I have a client that when they retired, they had a big tax event and that was all related to their retirement. And what we decided to do, and they're philanthropic, but what we decided to do was move a larger amount of money in that year because that was the year that they really got to take advantage of it. And now there's enough money there that every single year they just disperse 5% or actually in a year like this, it was a good year, so they're giving more, but they're just dispersing whatever that is each year and they fully satisfied their charitable giving for what they desire to do.
Absolutely. And I think that you also can look at it, especially you referred to someone referring and they had a large income event as part of their retirement. And that is absolutely a critical thing. When you do the analysis, it really comes down to, would you rather have it set aside that a charity is going to receive the money, or you're going to pay the taxes and the government receives the money? So most people, I think, would choose the charity.
It depends, right? But I think coming back to kind of how we started this call, the value is in the integration of the planning with these specific strategies, right? Because everything we've talked about here is financial planning. It's about investments and specifically looking at each of the investments. It's the tax work, right? Like, and integrating all of that. That to me, it really is ultimately why an advisor should exist, right? And I do think that really what we're trying to do here is solve people's problems.
That's right.
And more importantly, put ourselves in a position to be able to anticipate those problems before they actually manifest. And what we're talking about here right now is a lot of tax.
Absolutely.
So we talked about DAFs, donor advised funds, but also when you turn 70 and a half, you can actually do what are called qualified charitable distributions. Let's talk a little bit about that.
So what a qualified charitable distribution is that you are actually taking it directly from your IRA and giving it directly to the charity. Where this is an advantage is that it happens what we call above the line, which means that it happens before it gets calculated into your AGI. And therefore, it affects your IRMA bracket with your Medicare premium. So that's where that can be very advantageous, is utilizing that strategy, but in order to take advantage of a lower Medicare premium. And so really, when you get ready to actually employ this strategy, we like to look at it both ways. Are you better off taking it as a QCD, or are you better off taking it as a charitable donation?
Which is bottom line.
Which is the bottom line.
So real quickly, I want to explain your IRMA comment for anyone who doesn't know. When you get of age for Medicare,
correct.
Medicare Part A is free to everybody, but Part B is determined by your income from 2 years prior.
That's right.
So that is a rolling clock, right? So everything we're doing, so for example, 2024 is determining 2026
That's exactly
IRMA
right.
brackets.
Yes.
Right. And so to your point, if we do the route of charitable giving with highly appreciated stock, our taxable income is it's actually modified adjusted gross income, but it is that number. And whatever we do from a deduction perspective does not benefit what our IRMA brackets are because it does not impact the modified adjusted income calculation.
That's exactly right.
Whereas if we do qualified charitable distributions, and again, once you're age 70 and a half, so we can't do it prior to that, but we can then reduce the top line.
That's right.
Right, which is then actually having an impact on IRMA.
That's right.
But the other benefit is required minimum distributions, right? And this is the main reason.
Absolutely.
You're really bringing up a good point for me. But the main reason we do it is to actually reduce what someone's required minimum distribution will be.
Right.
So, for example, if they're required to take out 200 and they decide they want to give away 20, well, their 200 drops down to 180.
That's right.
And again, that's a top line. So it is benefiting the IRMA calc, but it's also facilitating philanthropic wishes.
And also, the QCDs can be done just like you give. So if you give a charity a certain amount every single month, we can set it up that the QCD also gives it every single month. So it looks exactly like you're doing it today. You're just getting the tax benefit.
So to summarize, charitable giving should be done from your brokerage accounts and your IRA accounts, not from your checking account.
That's exactly right.
And if there's any takeaway, I would continue to emphasize that from today's podcast. Charitable giving, it's important. If you're going to do it, do not write checks. And somebody asked me recently, like how small should we really be applying that? And
$100. I mean, as small as you want to go.
I would say if you're going to give under 50, just write the check, right? Like that's the number. But if you're going to be doing bigger ones,
that's right.
So like my church now, we're just doing, we do it right out of the donor advised funds.
Absolutely.
And we're doing it on I think monthly cadence. I should know this, but it's monthly. And then I look at the end of the year and I true everything up.
That's right.
Like it's automated,
That's
right?
right.
Like I don't think about it.
And then if you're traveling, if you're not actually in attendance, it automatically happens. So
correct.
You don't have to worry about it. And all of your charities are already set up in advance. So from year to year to year, the ones that you want to repeat, it's already there. It's very easy to put that in place.
Well, and the other thing in both of these strategies, whether it be the donor advised fund or the QCDs, the charities are getting cash, right? They're not getting a stock share that they would have to be selling the stock because some of these smaller nonprofits don't have brokerage accounts to receive stock.
That's right.
So especially if they're smaller and we just want to send them a donor advised fund check, that's a great way of doing it.
That's right.
All right. We talked a lot about charitable giving and we've talked a lot about tax.
One more thing about tax, so while we're on the subject, is this year is probably not the optimal year to do it because the market has had a very strong year. However, it's still worth looking at your entire portfolio. And are there any losses that in your brokerage accounts that you could go ahead and sell out of? We call that tax loss harvesting.
Correct.
In order to count against any earlier gains. Again, it can just mean, incremental difference, but it can make a big difference and every single year, even if it's small, you can do it. Back in 2022, when we had really challenging markets, we were able to do quite a bit of tax loss harvesting that are still benefiting clients today because of the carry loss forward. So never underestimate looking at that every single year.
Oh, it's the proverbial lemon that comes out of or lemonade that comes out of the lemon, right? I mean, it's so just to recap, tax loss harvesting is if you have a stock position in a brokerage account that's at a loss, you sell it. No one likes having the loss. I get that. If you wait 31 days, you can buy it back and then still have that position, but still manifest the loss. By the way, the 31 days is important because otherwise you get what's called a wash sale, disallows the loss, right?
And you've got to be careful that you don't have it bought in another account. So make sure that everything is coordinated.
Well, and so we saw this a lot with the energy companies. If not right now because all of them are doing so well, but if someone also gets a restricted stock grant,
correct,
that also counts as an acquisition, which can disallow any losses that are in there. I don't know a whole lot of energy employees that have shares at losses right now, to be honest. But if you did and you were to sell them, receiving a restricted stock grant could disallow that loss.
That's exactly right. Yes.
So again, it's another one of these nuances, consult your advisor, consult your CPA, and make sure it's integrated in the conversation. But I want to emphasize that point. We harvested losses in 2022 and are still reaping the benefits.
Absolutely.
So again, it's the proverbial lemonade that came out of the lemon. We didn't like having losses, but it was nice to be able to have them. Now, that said, I would always rather have a gain I have to pay tax on, right?
It's always like you'd rather have income that you've got to pay taxes on than not having the income.
Correct. You're right. So it's one where if you have to pay some tax on a gain, I'd rather have the gain than not have the gain, right? So
that's right.
These are great problems to have, right?
So,
all right, let's talk about any other year-end things.
One other tax concerning one is really analyzing Roth conversions.
Thank you.
So a Roth conversion is when you have the ability to take IRA money and move it into a Roth. Now, it looks just like a distribution from an IRA, so it is fully taxable at ordinary income. However, what you're doing is you're moving it into a Roth, and hopefully you can strategically do it in a year where you've got fairly low taxes in order to do the Roth conversion and then be able to, now you've moved it into an account that grows tax-free for the rest of your life. And it helps to avoid or lower, not avoid, but lower your required minimum distributions at either 73 or 75.
And so if you think about your effective tax rate in terms of just as a percentage, not your marginal, but your percentage, right? And so what we find is a lot of individuals retire and all of a sudden their effective tax rate actually declines from where it was when they were working.
That's right.
And then fast forward when they hit required minimum distribution age, which is 73 or 75, depending upon what year you were born, all of a sudden their effective tax rates parabolically moves back up. It's like a hockey stick.
Absolutely.
And so this conversation of, we're essentially pulling forward taxes we're going to pay in the future, but what we're doing is smoothing the curve out, right?
That's right.
Where instead of being this low drop and then parabolic back up, everything is more, let's just say incrementally or marginally moving forward. And I've had clients recently, especially recently, saying, well, why don't we do more?
Yes.
Right? Like higher
I have
conversions.
also.
Like, why don't we convert through the 32 or the 35% bracket? And there is candidly some logic there in the sense that we know that tax rates are going to go up at the end of 2025, assuming no legislative reform. I think it's safe to assume in the future taxes are going to go up. They have to,
agree.
right? And so I could agree with the logic on a marginal context for 2024 and 2025 to maybe do a little bit more, but the reality of it is it still comes back to economics. And there is opportunity cost on that cash that we have to spend on taxes.
That's right.
Because taxes are an expense, right?
Right.
And it's not one that I'm cavalier to say, let's just spend all this money on taxes because that's now money you don't have available to invest and grow, use for cash flows, et cetera. So there is an optimization that has to be done on this Roth conversion analysis.
That's right.
And what I like to do, and we've got our planning team that are helping with running all of these different scenarios, but what I like to do is look at the projection of where we assume the assets are going to be at required minimum distribution age. And then look at what that future effective tax rate is, discount it back to today. It's a very clear inflection point of we need to be doing conversions at this level.
That's right.
Now, and again, in certain cases, I could argue, and just a little caveat. Most of our households are married and both are alive while we're doing this planning. That's not how life works all the time, right? And so that's an example, though, where a very material change can happen by moving from married filing joint tax rates to individual tax rates.
Devastating.
And we've seen it manifest. We had an individual who had a heart attack at 68. All of a sudden, we've got a couple years where we can throw some more money in at joint rates, but the reality of it is big pre-tax accounts. And that RMD number doesn't change whether you're single or married.
That's right.
And all of a sudden now, all of the tax assumptions that we had made got impacted because of that. So it does emphasize or bring back to the necessitation of doing Roth conversions, especially if you have large IRA accounts. But really, it needs to be done still with an economic mindset associated with the expense of taxes now.
That's right.
Versus ultimately where we're going to be in the future.
We also like to look at what is your break-even date. So if you do the Roth conversions, when does it become a true tax savings to you with your RMDs coming down? And that's something that we think is a valuable number to add into the conversation also.
And I know we're going to talk about legacy in a minute, but it's also important to note if you're in if you're a household that's in the position that is leaving money to your children or next generation, there is value in having money positioned in Roths versus traditional IRAs. And more importantly, it's because spousal beneficiaries, so your spouse, it's essentially the same as you, right? For the most part. But anyone else, and I'm just going to use kids as an example, they have 10 years that they have to take this money out of these retirement accounts. That's IRAs and Roth IRAs, right? So that can be meaningful, right? You have a $3 million IRA account, 10 years, that's $300,000 a year. And by the way, most of the time these kids are inheriting the monies in their peak earning years.
That's right.
So it's like, that could be very detrimental. So the thing is the Roths still have 10 years.
That's right.
But it's tax-free,
That's
right? And a lot of times with the Roths, we tell the beneficiaries, leave it in there for 10 years, take it all out, right?
That's right.
Little caveat, this is a recent tax letter ruling from the IRS, is that the children with the IRAs, they don't necessarily have 10 years that they can just defer it 10 years and take it out. If mom or dad or whoever it was that they inherited the IRA from already started taking the RMDs, they have to continue taking the RMDs. Otherwise, they're going to have to pay
then the
penalty.
lump sum by the 10th year.
And then a lump by the 10th year. Yeah. So a lot of times what we do, like for a household, I've got a household right now where they had inherited an IRA from their parents. And they also have this pre-tax issue that we're talking about where they have large pre-tax accounts that we need to convert before they turn 75. What we're doing for them as an example is just modeling it year over year over year, watching how those the inherited IRAs, are performing. But we're placing emphasis on Roth conversions now because the inherited IRAs, you just have to distribute. It comes out, you spend the money.
Right. Exactly.
With the IRAs, you can move it to a Roth and let it go. But the point that I was making is that if you're going to be leaving money to your kids or next generation, in the Roth is absolutely a better place than in the IRA.
Right.
So if there's a legacy conversation, we can extend this analysis out for an additional 10 years.
That's right. And even if they change the rules again unexpectedly on us for inherited Roths or IRAs, it's still not having a tax consequence, even if they took away the 10-year rule. And we don't think they will, but you never know what Congress may do.
The 10-year rule came in 2019.
But it's still tax-free. So therefore, it's still better than the IRA for sure.
Completely agree. Yeah. But sorry, I'm just like jumping in on these. I think a lot of clients say, well, I want everything in the Roth. Actually, that's not true because it comes back to this tax analysis, right? The best portfolio structure is a combination of non-qualified, qualified, and Roth, right? And so it's one where every household is different. That's why the plan is so important.
That's right.
But ultimately, you don't want to have everything in the Roth because in most instances, you're going to be paying a lot of money at some point early on to get it there. Yeah, exactly.
That's exactly right.
All right. What else non-tax?
So really then we go into non-tax. We get into some estate planning ideas. So number one is every year it's very important to do a beneficiary review on all of your accounts. Accounts get opened and closed. Accidentally, the beneficiary is not updated properly. Things change. You may have had people named as a beneficiary, and then in the year you created a trust, and the beneficiary never got changed to ultimately be your trust. But you want to make sure that all of your documents are aligned. You don't want to have a conflict between what's on an IRA account and what may be in a trust document. So that's very important.
Let's talk about why, though, real quick.
Okay, sure.
The IRA always trumps.
Correct.
Sorry, the IRA beneficiary designations always trumps whatever we have in a will or a trust.
That is correct. So you want to make sure that they all say the same thing. And you don't have conflicts that you're creating. But doing that, and there have been times when accounts have gotten opened and accidentally the beneficiary never got at it. And if somebody passed away and there's no beneficiary, automatically you've got, an estate when you've been trying to do everything possible to avoid having a probate estate.
And that's why, to emphasize this, it's reviewing every single account, right? Because
absolutely.
Like you just said, we could have one that gets open for whatever anecdotal reason, and next thing you know, we've messed up an entire plan.
Yeah. The second thing that's non-taxable that we should really talk about is gifting strategies. Okay. So as an individual, one person is allowed to give $18,000 a year to anyone that they would like to. And it's really, you can think of it in lots of different ways. If you know that you're going to have extra money left over in your estate when you pass away, gifting strategies can be wonderful to give to your kids today or to your grandkids. That can be a fabulous strategy. And there's no taxable consequence for you gifting or for them receiving, meaning that you don't have to report the gift as a tax. Now, obviously, if you had to raise capital gains to create the cash, that is a taxable situation. But the act of the gifting is not.
Yep.
So that's critical from that perspective. And then in conjunction with that is actually funding grandchildren or children's 529 education plans, because you also can work with your gifting strategies in funding those particular situations. Whole different situation that you might even want to think about is if you want to gift more to your kids, but you reach the $18,000 limit, you can gift say your grandkids are going to a private school, you can give a portion of that tuition directly to the school, and that is a way to gift more to your family, and you haven't exceeded the gift limits.
Yep.
So there's so many different strategies around gifting, again, very specific to each person, but it definitely warrants a conversation to look at all of the things that you may be able to take advantage of.
Yeah, this is, just to summarize this real quick, if you're in a position that you want to give to your children or someone else that's important to you, you can give $18,000 a year. By the way, if you're married, it's 18 each. That's
Correct.
36. So if you have a child, you can give 36. By the way, if that child's married, you can also give to the spouse. They're 72. I mean, we can find lots of ways to give away money. But it's a great way of facilitating this wealth transfer in a very low cost, tax efficient manner that can have meaningful impact early on.
Right.
Real quick on the 529s, there's actually a nuance with the 529s. You can actually gift up to 5 years at once. So if it's 18 times 2, that's 36. You can actually give $180,000 in one check.
That's right.
So, and again, I've only seen this in isolated cases, but grandpa, grandma might say, hey, look, I got a new grandbaby. I want to go ahead and take care of college, put $180,000 in. And that's actually going to be pretty darn close to fully funding the entire 529 need.
Absolutely.
And the benefit of a 529 is that that money is going to grow completely tax-free as long as it's used for qualified education expenses. We can use up to $10,000 a year for private school along the way. K through 12. K through 12, yep. And then college, there's no cap as long as it's a qualified education expense.
And then if they get scholarships, it can defer to graduate school.
Well, with scholarships, they can get a tax-free distribution in the equivalent amount for the scholarship.
That is true, yes.
And grandpa, grandma, or mom and dad can always change the beneficiary.
That's right.
Right. So there's a lot of reasons that, we come back to like the ethos of this conversation. A lot of it is how we're saving, how we're accumulating wealth. 529s are a great conduit if higher education is important to your family and vice versa. But I will say that it's important to place that emphasis on the 18,000. There is no record that needs to happen.
That's right.
Like there's no anything on the tax returns there for either side, right? For you or for the kids. Now, if we go above that, let's say the kids need to buy a house.
And you want to do a down payment.
Correct. Well, and we know that's coming. Well, to this point, maybe what we do is we give them the 36, husband and wife, 36 right now here at the end of the year. Give them another 36 actually at the beginning of, And actually in 2025, it's 19 each. So it's going to be now 38. But the point is that you can spread it out
That's right.
to help facilitate that goal. And if we need to do it more eminently, like they find the place and we need to go, then we just structure it as a loan and we forgive it year over year over year.
Absolutely.
And
there's so
work
many
it that
ways
way.
to structure that. Absolutely. And in conjunction with that, one of the other things that you do want to look at is where do your emergency cash reserve account stand? It's been a good year. You referenced at the very beginning, people have spent a little bit more than normal in a lot of cases this year. So have you depleted your cash reserves? Do we need to replenish that? Especially markets are good. Do we want to make sure that we get that replenished correctly? That's important to always keep that in mind. And then the final thing I would say is to make sure that you're doing a full comprehensive estate document review every single year. You might change where you live. That's important. The laws may change and you may need to have your documents updated to comply with the current law. You may need different documents. Different people may have passed away that are included in your document that you need to offset. Different people may have been born. So it's just very important to do a full comprehensive review every single year.
We've talked about a lot today. I think we even went a little bit over our time limit, but thank you, Nell. This is probably one that we could continue to have this conversation. If you have any questions, you need us, Nell and I are always available. Anyone at Bogart Wealth is available to be a resource for you. Thank you.
Thank you.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.